So, in the previous class, we discussed why it is important to read, interpret, and understand financial statements of a business. So, let's discuss now what are the financial statements. So, basically, every business in the world, be your small business or let's say a big business like Tesla, will have three major financial statements. Number one is what we call income statement. Income statement, as the name suggests, it shows how much do my business earned during a period. We make the financial statements for a period. So, how much my business earned during, let's say, a single quarter, that is for 3 months, or for 6 months, or an year. Usually, income statements are prepared every quarter or sometimes annually also. So, how much do my business earned during a given period? And this income statement has complete details of types of revenues earned and the expenses paid to earn those revenues. The second one is the balance sheet. Balance sheet, it says what do I own and what do I owe in my business. Basically, every business has two things, assets and liabilities. In liabilities, we have two ways to fund the business, debt and equity. So basically, the balance sheet tells you how much money you have put in the business as equity, that is your skin in the game, and how much you have borrowed from others that comprise of liabilities, and those liabilities funds the assets of the business. Later in the course, we will discuss each and every of these financial statements in detail. The third one is cash flow statement, and this is definitely my favorite financial statement. It shows where is the cash coming and where is the cash going out of my business. It basically shows you where is the money. So let's start with the first one, the income statement. Income statement tells you how much I made during a given period. Now to understand income statement, here is a simple trick. Every income statement in the world can be written effectively in this format. And that is the beauty of understanding income statement. In income statement, we have basically three things which I have highlighted here: gross profit, operating profit, and net income. And the entire income statement revolves around these three figures. If you understand these three figures, you have effectively understood income statement. So every income statement in the world begins with revenues. What are revenues? Revenues are basically those money which a business has earned from selling the goods or services. From these revenues, you deduct or you minus the cost of goods sold. What are cost of goods sold? These are basically expenses which are directly associated with producing these goods or services. The most important word here is directly. That means, let's assume if the Apple is producing an iPhone, then in producing that iPhone, what is the first expense which Apple has to incur for producing that iPhone? That will be the body of that iPhone. So the body of that iPhone will be the example of the cost of goods sold. The another example will be the labor which has been put in, or the technicians which have put in the hard work of producing that iPhone. So that labor will also become the part of cost of goods sold for producing that iPhone. When you deduct cost of goods sold from revenues, you get gross profit. And here comes one of the most important things which you now have to do in your business. Instead of looking just at the net profit or whatever you have earned at the end of the year, look at your income statement in this format. First of all, understand what is the gross profit earned by your business. Why we are bifurcating these profits into gross, operating, and net, I will tell you in detail when we understand the practical implications. But understand this, to get gross profit, you have to basically deduct cost of goods sold from the revenues. And what does gross profit represents? Gross profits basically represent the marginal profits you earn by selling your product or service. What I mean by that is, so let's assume that the gross profit of Apple is 60%. That means for every iPhone they sold for X amount of dollars, they get 60% of that dollars as their gross profits. So they have to basically incur only 40% to produce that iPhone. But when the iPhone is produced, the job is not done. What next the Apple has to do? It has to incur expenses on employees, on marketing, on administrative, on all those plant machineries and equipments which Apple has in its factories. So, from gross profit, we deduct something called other operating expenses. What are these other operating expenses? These are those expenses which are not directly related with producing goods or services, like marketing, like general staff salaries, administrative expenses, logistics expenses, you name them. Whatever expense which Apple is incurring, or what even your business is incurring, and that is not directly associated with your product or service, that will covered into other operating expenses. For example, depreciation, it will be covered in the other operating expenses. From the gross profit, when you deduct other operating expenses, you get what? Operating profit. Now the first was gross profit, which was telling the marginal profit by selling your product or service. The next one is operating profit. Operating profit means how much is the profitability of your business before paying your debt finances. What I mean by that debt finances is basically before paying your interest expenses. So whatever, if let's say if your business has no debt, then this operating profit will be finally your taxable income, right? But let's assume that you have debt, that you have taken some debt, then from those operating profit or the profitability of business, you will deduct the expenses for financing your debt, that is the interest on your loans taken. By paying your debt holders, you finally get taxable income. This is the income on which government is gonna deduct taxes. There are two things in life, debt and taxes. So you have to pay taxes on your income. So this is the income for the equity investors, that is the owners, that is you, prior to paying the government share. So when the taxes are the government shares which they require from your income, and finally you get what? You get the sweet figure of net income, that is the profit which is yours and yours only, or what we call income for equity investors or the owners of the business. Now I can understand this all can be quite difficult to understand at one go. So let's take a very simple Excel example. So let's say you are the owner of a small business with the following figures, and let's say all the figures are in dollars. We have sales of $1,000. Let's assume that we are manufacturing a product. For that, we have gotten the sale of $1,000. For getting that product manufactured, we have to incur expenses of labor, material, etc., and that comes out to be $400. So that means after sales and deducting cost of goods sold, what we got? Gross profit, right? So this is basically the marginal profit which I'm getting by selling my product. That means for every dollar of product I sold, I basically earned 60 cents on every dollar of product. Or the other way of saying it is, basically I have to incur 40 cents to earn a dollar for a revenue of sale. Now from this gross profits, we deduct something called selling and general expenses, our other operating expenses, let's say which includes a depreciation of $20 also. So after deducting this SG&A or other operating expenses, we get what? We get what we are getting, our operating profit of the business. So our profits of the business are very healthy. We are earning 30% on every dollar of revenue. From this, let's assume that we have taken a debt. On the servicing of debt, we have to pay interest of $50 a year, and we got basically a taxable income of $250. From this taxable income, let's say assume that the tax is 30% and we got a tax of $75 and net income is $175. So again, we have three things which I have told you: net income, our operating profit, and our gross profit. So this gross profit 60%, that is a marginal profit. How I have calculated operating profit? I have simply taken operating profit divided by sales. That gives you an operating profit. And net income, very simple again. We take our net income and divide by sales. Now, remember, the next time you are making or seeing the income statement of your business, don't just deduct all the expenses and look at just the final figure. Look at your income statement in this way. Why? Well, here is a trick. You know this gross profit? So what is the difference between gross and operating profit? It's basically your other operating expenses, right? Now, here's the thing about other operating expenses. Let's assume that Apple or even your business, you are producing a good or you're providing a service. The nature of other operating expenses, like selling and general expenses, the salaries of your employees, your transportation costs, are usually fixed in nature. What I mean by that is that even if you're doubling your sales, that doesn't mean that you will double your marketing budget. Of course, it can happen, let's say, in a quarter or a part of a year. But on a long term basis, let's say on a yearly basis, those selling expenses will not increase in direct proportion to your cost of goods sold expenses. What does this mean? It means that if your gross profit is high, which is very high in this example, and if I double the sales, my profit will not just double, it will more than double. Let me show you by the example. So take this example. Let's assume that suddenly our sales double. Due to whatever reason, let's assume that our product becomes a hit, or people start liking the product more, or we are able to increase the prices also more. Let's take any other example. So let's assume that our sales double to $2,000. What will happen? Our cost of goods sold will definitely double. Why? Because it is directly associated with producing that good or providing that service. That means we have to provide more material, more labor, or if we are in a service business, we have to hire more people to provide that service. So what will happen to my gross profit? My gross profit doubles and it remains the same at 60%, right? Now, here is the kicker. The other operating expenses, they are not going to double. When it comes to a long-term basis or an yearly basis, their marketing expenses is not going to double. My salary to the employees will not double. It will increase. I'm not saying it will remain the same usually, but it will increase. But the increase will be lower than the increase in the sales. So what will happen? My operating profit rises. So my operating profit from 30% becomes 40%. Now the interest will remain the same because I have not taken additional debt. And what happened to my profitable income? My net income, that balloons from 17.5% to 26%. So the increase or the doubling of my sales doesn't mean that my expenses or my operating profit also doubles. So the doubling sale have an exponential increase in my operating profit. Why? Because my other administrative expenses or my other operating expenses are not increasing in that proportion as my sales are increasing. And that is why, guys, it is very important to bifurcate your income statement in this way. Think of your income statement not in terms of just a line and end line item. Okay, this is a profit. Think of your income statement in these terms, in gross profit, in operating profit, and in net income, to really understand how to increase the efficiency of your business.